I want you to think about everything you learned in school. Algebra, the periodic table, the three branches of government, how to dissect a frog. Now tell me, did anyone, even once, sit you down and explain how a mortgage actually works? How compound interest can either make you rich or destroy you? Why your paycheck is not an asset? Why the bank that holds your savings account is not on your side? No, they didn't. And here's what that silence cost an entire generation of Americans. The average American household carries $104,000 in debt, not including the mortgage, credit cards, car loans, student loans, medical bills. $104,000 of debt on top of a mortgage most people will spend 30 years paying off. Meanwhile, the top 1% of Americans own more wealth than the bottom 90% combined. That gap did not happen because rich people worked harder. It happened because rich people learned a completely different set of rules. And nobody taught those rules in any school, in any classroom, at any grade level. Not in 1975, not in 1995, and not today. The question I keep coming back to, the one I genuinely cannot stop thinking about, is this. What if the wealth gap in America is not a talent gap, not a work ethic gap, not even an income gap? What if it's purely an education gap? What if the people quietly building wealth on normal salaries simply know 5 or 6 things that nobody taught you, and once you know them too, everything changes? That's what this video is about. Stay until the end, because the last thing I'm going to show you is the one concept that ties everything else together. The one that, once you understand it, makes you genuinely angry that nobody explained it sooner. Let's go. Before we get to the specific lessons, I need to show you something uncomfortable. The fact that you were never taught personal finance is not an accident. Think about who benefits when you don't understand money. Banks benefit when you keep your savings in an account paying 0.01% while they lend your money out at 7%. They collect the difference called the spread, and they do it on every dollar of every account every single day. Credit card companies benefit when you don't understand what 23.79% upper actually means in dollars. Because if you did understand it, really understood it, you would never carry a balance ever. Car dealerships benefit when you focus on the monthly payment instead of the total cost, because a $700 a month payment sounds manageable. The $54,000 you'll pay over 6 years plus $8,000 in interest is a different conversation. And here's the part that should genuinely disturb you. The financial industry in America spends approximately $17 billion a year on advertising. $17 billion to make sure that when you think about money, you think about spending it, not building it. Nobody spends $17 nexting you to save. Robert Kiyosaki said something in Rich Dad, Poor Dad that millions of people have read but most haven't fully absorbed. He said, "The rich don't work for money, they make money work for them." What he didn't say clearly enough is that making money work for you requires knowing rules that the financial system has no incentive to teach you. Today, those rules end their hiding. Pay close attention to lessons 3, 6, and 8. Those are the ones that will hit the hardest. Most financial content creators skip them entirely. Lesson 1, your paycheck is not an asset, it's a liability in disguise. This is the first thing schools should teach. They never do. Here's what makes something an asset. It puts money in your pocket whether you show up or not. Your paycheck does the opposite. The moment you stop showing up, sick day, layoff, injury, family emergency, it disappears. Completely. Instantly. That means the thing most Americans spend their entire career protecting and growing is not actually wealth. It's access to wealth for as long as nothing goes wrong. And here's the math that makes this concrete. The average American works 90,000 hours over their career. 90,000 hours of labor, most of it exchanged for a paycheck that stops the moment the labor stops. The wealthy spend those same hours building things that generate income without requiring their presence. A rental property that collects rent while they sleep. An index fund that grows while they're on vacation. A business that runs while they're at their kids' baseball game. The shift from earning to owning is not a luxury for people who are already rich. It's the mechanism by which people become rich. Every dollar you redirect from consumption toward ownership is a dollar that starts working for you instead of disappearing. Lesson 2, compound interest is either your greatest ally or your worst enemy. Most people have it working against them. Albert Einstein reportedly called compound interest the 8th wonder of the world. Whether he actually said it doesn't matter, the math is undeniable. Here's how it works for you. You invest $10,000 at 7% annual return. Year 1, $700. Year 2, $749, because you're now earning 7% on $10 7 times, not just $10,000. Year 3, $8 too. The number that gets added keeps growing permanently without you doing anything. After 30 years, that single $10,000 investment becomes $76,000. You added nothing. The compounding did all the work. Now, here's how compound interest works against you, and this is the part nobody shows you. That same $10 on a credit card at 23, 79% APR, paid at the minimum, compounds in the other direction. By year 5, you've paid thousands in interest and barely touched the principal. The bank is earning 23% on your balance, compounding monthly, while your savings account earns 0.001%. The distance between those two numbers, 23, 79% working against you and 7% working for you, is the entire wealth gap in America, explained in one sentence. Most Americans have compound interest running in both directions simultaneously, and the negative direction is winning. Lesson 3, and pay close attention here. The bank is not storing your money, it's borrowing it. This is the one that genuinely shocks people when they hear it for the first time. When you deposit $10 in a checking account at a major bank, that money does not sit in a vault with your name on it. The bank immediately lends the vast majority of it out to mortgage borrowers at 5%, to car buyers at 7%, to credit card holders at 23%. The bank borrows your money at 0.01% and lends it out at anywhere from 6% to 24%. That difference, called the net interest margin, is how banks generate billions in profit every quarter. You are the lender, the bank is the borrower, and they're paying you almost nothing for the privilege of using your money to make themselves wealthy. Here's what that costs the average American. The FDIC reports the national average savings account pays 38%. The best high-yield savings accounts right now pay 2%. Same FDIC insurance, same access to your money, same safety. $50,000 in a big bank savings account, $190 a year in interest. $50,000 in a high-yield savings account at 2%, $290 a year. The difference is $19.10 annually for doing nothing except moving your money once to an account with identical government insurance. Over 10 years, that single decision is worth over $20,000. Not from investing, not from risk, from simply understanding how banks actually work. Lesson 4. The tax code is written for asset owners, not wage earners. Nobody teaches this in school, and it might be the most consequential financial lesson in America. If you earn $100,000 from a job, the IRS takes federal income tax, state income tax if your state has one, Social Security tax, and Medicare tax. Depending on your state, you might take home $65,000 to $72,000. If you earn $100,000 from selling investments you held for more than a year called long-term capital gains, you might pay 15% in federal tax and nothing in payroll tax, and you keep $85,000, same $100,000. Completely different tax treatment. The IRS taxes wages at the highest rate. It taxes investment income at a lower rate. It taxes real estate income with deductions that wages don't get. It gives retirement accounts that defer or eliminate taxes entirely on investment growth. Warren Buffett has publicly stated that he pays a lower effective tax rate than his secretary. He wasn't bragging. He was pointing out exactly this. The tax code is structured to reward people who own things and tax people who work for things. The Roth IRA is the clearest example of this available to regular Americans. Contribute money you've already paid taxes on. Invest it in an index fund. Watch it grow for 30 years. The government never touches the growth, not ever, not at retirement, not at withdrawal. $7,500 a year into a Roth IRA at 7% real returns for 30 years becomes approximately $756,000 completely tax-free. That's not a loophole. It's a published legal account that the IRS created specifically to encourage long-term investment. Most Americans either don't use it or start too late. Lesson 5. A mortgage is not debt. It's a forced savings plan with rent attached. This is the nuance about homeownership that neither side of the rent versus buy debate explains correctly. Yes, a mortgage is debt. Yes, you pay interest. Yes, the bank profits. But here's what renting never does. It never builds equity. Every rent check is 100% an expense. Every mortgage payment, even the interest portion, is buying you something and increasing ownership stake in an asset that historically appreciates over time. The United States has a structural shortage of 4 to 7 million housing units. That shortage doesn't resolve quickly. It resolves over decades, which means the asset you're buying into has structural upward price pressure for the foreseeable future. The family that bought a median-priced American home in 2004 for $221,000, now since at the peak, before the 2008 crash owns a home worth approximately $200,000 today, even after living through one of the worst housing crashes in American history. Nobody taught you that in school either. Lesson 6, and this is the one that hits hardest: inflation is a hidden tax that destroys savers and rewards owners. This is the lesson that makes people angry when they truly understand it, because it means doing nothing with your money is not neutral. It is actively losing. Inflation in April 2026 came in at 3.8%. That means hundreds existing in a checking account earning zero. Their 1% is worth 96.21 in purchasing power 1 year from now. You did nothing wrong. You worked hard. You saved. And your savings are disappearing not dramatically, not all at once, but reliably, consistently, permanently, every single year. This is not an accident of the economic system. It is a feature of it. The Federal Reserve explicitly targets 2% inflation, meaning some amount of your savings disappearing every year is the stated policy goal of the US central bank. Now, here's what nobody tells you about inflation. It doesn't destroy everything equally. Cash, destroyed by inflation. Bonds at low yields, destroyed by inflation. Savings accounts at big banks, destroyed by inflation. Real estate historically keeps pace with or exceeds inflation. Stocks historically outpace inflation significantly over long periods. Index funds historically beat inflation by 4 to 5% per year on average. Inflation is a tax on savers and a tailwind for owners. The wealthy know this. That's why they hold assets, not cash. The question inflation forces you to answer is not, should I invest? The question is, can I afford not to? The math says no. Lesson 7: dollar cost averaging is how regular people beat professional investors. Every year, professional fund managers with teams of analysts, proprietary software, and decades of experience try to time the stock market to buy at the bottom and sell at the top. And every year, the majority of them underperform a simple S&P 500 index fund. Not because they're not smart. Because timing the market consistently is mathematically close to impossible, and the costs of being wrong are catastrophic. Dollar cost averaging is the opposite strategy. You invest the same fixed amount, $200, $500 every single month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices crash, your fixed amount buys more shares automatically, at lower prices. Over time, this averages out your cost per share, and historically, it has consistently outperformed both doing nothing and trying to time the market. The workers who were auto-enrolled in 401k plans in 2019, who dollar cost averaged straight through the March 2020 COVID crash without changing anything, are sitting on all-time high balances today. They didn't do anything heroic. They didn't time anything. They just kept buying. The people who panicked and sold in March 2020 locked in their losses permanently. Dollar cost averaging is not a sophisticated strategy. It's an unsexy, mechanical process that removes human emotion from investment decisions. And removing human emotion from investment decisions is how you build serious wealth on a normal income. Lesson 8, and pay very close attention to this one. Your net worth is not what you earn. It's the gap between what you earn and what you spend. This is the concept that destroys the myth of the high-earning broke person and explains why it's completely possible to build significant wealth on a $60,000 salary. Net worth is assets minus liabilities. That's it. A doctor earning $400,000 a year with a $1.2 million mortgage, 2 luxury car payments, private school tuition for 3 kids, and a lifestyle that absorbs every dollar has a net worth that could be negative, and many are. A teacher earning $58,000 a year who owns her home, drives a paid-off car, maxes her Roth IRA, invests 15% of her income in index funds, and spends deliberately can retire with over $1 million. The Millionaire Next Door, one of the most rigorous studies ever conducted on actual American wealth builders, found that the majority of millionaires in America do not live in wealthy neighborhoods, do not drive luxury cars, and do not look wealthy. They look ordinary because they prioritize the gap over the lifestyle. Here's the number that matters. The average American saves approximately 6% of their income. The average 401k millionaire people who built seven-figure balances on normal salaries saved an average of 17% of their income over their careers. The difference between financial stress and financial independence is not usually income. It's that 4% gap. Lesson 9: time in the market beats timing the market, always. Meet two people. We'll call them Early and Late. Early invests $500 a year from age 25 to 35, just 10 years, then stops completely, never invests another dollar. Total contributed $50,000. Late starts at 35 the exact year early, stopped and invests $1,000 a year all the way to 65. 30 straight years. Total contributed 155 ends. At 65, at a 7% real return, late 30 years of contributions, 155 ends invested has approximately 55 N. Early 10 years of contributions, $50,000 invested has approximately 62,000. Early invested a third of the money and ended up with $92,000 more. Not because of skill, not because of timing, because compound interest rewards the age of money more than the amount of money. $1 invested at 25 has 40 years to compound. $1 invested at 45 has 20. That's not a small difference. That is the difference between two completely different financial realities at retirement. The most expensive sentence in personal finance is, "I'll start investing when I make more money." The second most expensive, "I'll wait until the market comes down a little." The best time to start was your first paycheck. The second best time is your next one. Lesson 10, the final lesson nobody teaches. I'll come back to this one at the very end, but I need you to hold on to a question until we get there. The question is this: if all of this information exists, if these lessons are real and documented and provable, why do 67% of Americans still live paycheck to paycheck? Hold that question. We're going to answer it in about 2 minutes. First, what to actually do with everything you just learned. Why most people still fail. Here's the uncomfortable answer to the question I asked you. Knowing something and doing something are separated by one of the most powerful forces in human psychology, the gap between immediate discomfort and delayed reward. Putting $300 into an index fund this Friday feels like giving up $300 right now. The $807,000 that $300 a month at 7% becomes over 40 years is completely abstract and feels unreal. The restaurant is real. The new phone is real. The weekend trip is real. The retirement account balance in 2055 is a number on a hypothetical spreadsheet. And the entire consumer economy, every ad, every app, every checkout page is engineered to make the immediate feel urgent and the future feel irrelevant. This is why automation beats willpower every single time. The 401k works not because people are disciplined. It works because the money never hits checking. It's gone before the brain registers it as available. Workers who are auto-enrolled in 401k plans save at 5 times the rate of workers who have to actively opt in. Same income, same financial pressure, same human brain. The one lever you have against a $17 advertising machine is removing the decision entirely. Set up automatic contributions. Split your direct deposit before it hits checking. Make the saving happen without your conscious participation, because your conscious participation is exactly what the system is designed to capture. Not someday, this week. Step 1. Move your savings to a high-yield savings account this week, not next month. Today, big banks are paying 0.38%. High-yield savings accounts are paying 4.2%. Same insurance, one transfer. Step 2, if your employer offers a 401k match and you are not capturing every dollar of it, log in today and fix it. A 50% employer match is a guaranteed 50% return. Nothing else in finance offers that. Step 3, open a Roth IRA if you don't have one. Fidelity, Vanguard, or Schwab. Set up a monthly automatic contribution, even 100. The amount matters less than starting. The sooner a dollar enters the account, the longer it compounds. Step 4, look at every debt you're carrying above 7% interest. Credit cards at 23,000% are destroying compound interest in the wrong direction. Pay minimums on everything else and throw every spare dollar at the highest rate debt first. Step 5. Automate everything. Split your direct deposit before it touches checking. Make saving a system, not a decision. Remove your willpower from the equation entirely because your willpower has a 17 billion industry working against it daily. The final lesson. Here's the final thing nobody taught. The wealth gap in America is not primarily a resource gap. It's a knowledge gap that compounds the same way money does. Every year you don't understand compound interest, it works against you. Every year you leave savings in a 0.38% account, you're funding bank profits. Every year you don't invest, you lose the year of compounding you can never get back. The people who understood these lessons at 25 are not smarter than you. They are not harder workers. They were simply told different things. You know those things now. The question is what you do in the next 72 hours. Because here's what I've found studying this. The people who act within 72 hours of learning something important actually change their behavior. The people who bookmark it tell themselves they'll come back to it. Plan to start next month. Statistically, most of them don't. Your future self is being built right now by what you do this week. If this gave you even one thing worth acting on, subscribe, because every week I break down exactly how money actually works for people on normal salaries. No jargon, no hype, just the mechanics. See you next week.